Hello and good evening to all of you. We hope that you are in good health and staying safe. Thank you for joining us for today's webinar, Impact of COVID-19 on Transfer Pricing Analysis, a 360-degree view, hosted by Nexdigm. Joining us today, we have with us Purnima, Jignesh and Maulik, who will attempt us to analyze the impact of COVID-19 on tax strategies, in particular on transfer pricing policies adopted by multinationals. Purnima is a CFO at Principal Global Services. Along with leading finance, legal, and secretarial functions, she is also a part of the team responsible for global transfer pricing. Purnima is a seasoned professional and specializes in finance operations, corporate tax, treasury, transfer pricing, advanced pricing agreements, country-by-country reporting, and change management. We welcome you, Purnima, to our webinar. Jignesh has over 21 years of experience. He leads the tax function at Siemens. Before joining Siemens, he was with BMR and Associates and has worked with a diverse set of clients across industries. Jignesh specializes in the areas of corporate tax, transfer pricing, foreign investment consulting, company law, and exchange control. He regularly writes on these subjects for various magazines and portals. Jignesh is also an active member of the technical committees at CII and the Bombay Chamber of Commerce and Industry. We welcome you, Jignesh, to our webinar. Maulik heads the transfer pricing and the international tax teams at Nexdigm. He advises multinational corporations on Indian and international transfer pricing rules. Maulik's core areas include advising multinationals with Indian and foreign transfer pricing rules in all contexts, including planning, APAs, and documentation studies. Maulik has been recognized as a highly ranked practitioner by Euromoney's transfer pricing expert guides. We welcome you, Maulik, to our webinar. Dear listeners, if you have any questions for any of our speakers, please leave them in the questions box on the control panel, and we will definitely try to address them towards the end of the session. I now invite Maulik to take it up further. Over to you, Maulik.
Good afternoon, everyone. I welcome you once again on this webinar where we are going to discuss the impact of COVID-19 on transfer pricing. I hope all of you are safe, are coping up with the current challenge and the current situation everyone is in. I also wanted to thank Jignesh and Purnima to be agreeing to be a part of this webinar, being a part of this panel, and sharing their insights. They bring a lot of perspective in terms of the business side of it and the industry part of it. And I'm really thankful that they agreed and they are part of this panel. On the webinar today, we are going to discuss. There are several questions that are being raised right now, while businesses are currently coping up with the usual kind of trying to get to the new normal and trying to adjust to the new normal. It is also important and it is also critical that some of the other aspects of the businesses like tax, transfer pricing, financial health, etc., are also being kind of addressed. So while businesses are kind of trying to see how they can restart their kind of operations and come out of this challenge, questions on transfer pricing are also being raised, and they are being posed by different different lines of businesses and different functions within the businesses. There are questions in terms of how do you deal with this three-month period? In terms, how do you deal with the future impact of this? There is a disruption in the entire supply chain. How do you kind of organize yourself against this disruption? So there are a lot of those questions that are kind of coping up, and in the webinar today we are trying to attempt to answer some of those questions, to kind of brainstorm on what possible strategies could be there, and kind of see what we can take away back in terms of the impact areas that we can start kind of implementing at our end. So like I mentioned, we are having kind of lot of businesses coming ahead and questioning a lot of questions are getting kind of generated. There's a production company that kind of is incurring cost, but there are no sales happening. How does the production company pass on this cost? Do they build it as a part of the product costing and pass it on to the consumers? Do they pass it on to the distribution entities? How does that one happen? There are kind of license payments, committed payments to be made, license payment, interest charges that may lead the companies into losses. How does one deal with that kind of a situation? There are situations where for ages and for years together I've been using transactional net margin method, my net profit, to justify my intercompany transactions, and suddenly I find myself in a loss because of this particular scenario. How do I kind of justify my losses if I have to still continue to use the net margin method? Does this scenario require a separate transfer pricing analysis, a separate function assets and risk analysis? Does it require a kind of a separate documentation and a separate study to be done? What are the critical elements that one needs to capture in respect of this kind of a study that we do, or the impact of the current situation on the businesses? Is it possible to reduce margins of low risk entities, of captive service providers, which may be kind of doing low value intra group services? Is it possible to reduce their margins, given that at a parent company level, at a headquarter level, I'm facing issues on kind of reduced profitability, losses? I have to cut down the salaries of my people. So is it possible that I kind of take some leverage with reducing the profitability of some of the low risk entities within the group? So a lot of these questions are being put up, and a lot of these questions are being raised. There are not many clear answers to some of these questions. Obviously, the guidance from the tax authorities and from the tax department is not yet out, and we don't know whether there will be a specific guidance that will be available from the tax authorities. But economically, we have to look at these questions and these aspects in the same manner as we kind of did perhaps in the past. Yeah, this scenario is in a sense unparalleled. We don't have a precedent as such for such kind of a scenario in the recent past. The 2008 crisis was something which we kind of had come across, but that also by and large affected a large part of financial services sector. So in that sense, we still don't have a precedent in the recent past of the kind of pandemic that we are currently dealing with and the after effects of this pandemic. Pretty much every industry is kind of affected. We can't say that a particular industry is kind of insulated from that. The media, the entertainment and advertising industry is kind of the most severely affected, with impacts on travel, or impacts on kind of advertisement, because of the motion pictures releases have been stalled. There are no people kind of going into the theaters, etc. So a lot of this effect is there on the media advertising industry. Manufacturing is kind of affected because of the logistics, resulting in non-availability of raw materials, disruption in supply chain. The agriculture would get affected, mainly again because the prices are going to kind of go down with declining incomes and declining consumer spend. The transport warehousing sector again would be affected. The global trade itself is estimated to kind of contract by 33%, which is kind of going to have an effect on transport warehousing. The effects of manufacturing will also be seen on the trading sector, where again, because of the disruption in supply chain, there will be after effects. Infrastructure and construction also has taken a hit, because there is a heavy reliance on labor which cannot work from home, and therefore there is going to be an impact on the infrastructure sector also. Healthcare sector is kind of a mixed bag, while pharma stocks and pharma sector is kind of trying to come out with new methods to save us from this COVID-19 situation. The other areas like the optional spend of people on the healthcare side is going to definitely take a hit, and definitely people are going to see a decline in terms of some of the spend there. So in all, pretty much all sectors, all industries, and all areas of businesses are getting affected because of the COVID-19 pandemic that we are in right now. And not a particular sector, it can be said to be kind of really not affected by the current situation. In terms of the impact area in transfer pricing, we see kind of a significant portion of this also translating into the transfer pricing effect areas. The most important impact on transfer pricing is the disruption of the supply chain, where the operation is centralized may now go into a decentralized model. A lot of manufacturing used to take place out of India and China, and China being the worst affected in the initial period is going to see is kind of seeing a disruption in the supply chain in terms of goods emerging out of that country. In terms of people, in terms of liquidity, there is a significant impact. There are kind of people getting stranded in different countries, and therefore the key decision makers, etc., are kind of impacted in their own countries. The new locations are there for functions being performed, because suddenly you see that a particular say IT function, if it's based out of a country which is affected severely by COVID-19, the management would have taken a decision to shift the IT function from, say, India to some other country to kind of temporarily meet the requirements. So because of the situation, there will be new locations for functions being performed. Even in terms of liquidity, there will be that would be the most companies are grappling with cash right now. Collecting of receivables, etc., is the major area of focus. But intercompany advances and intercompany loans are going to see a major restructuring around that. There is already a waiver and moratorium being introduced by a lot of central banks for their own countries in terms of the loans, etc. Similar effect we'll see in the intra-group loans also. And all this will culminate into effect on transfer pricing policies. There will be kind of possibly will define a new arm's length criteria for COVID-19. We need to kind of understand and decide what happens to the additional cost that is there on account of idle capacity, on account of logistics, certain cost on account of COVID-19 crisis management. Even after the opening up of the sectors and opening up of the factories, there are significant do's and don'ts being kind of put forward by the government in terms of social distancing, in terms of sanitization, in terms of various other precautions that are to be taken. And there's a cost attached to all of this, so there will be an additional cost for industry, and one needs to do and assess the treatment of such extraordinary cost that will be there. And all the change in TP policy also would require hard look at your intercompany agreements, evaluation of the force majeure clause, if it is there in the intercompany agreement. So a lot of these things kind of a lot of these areas would get impacted. Transfer pricing, kind of like any other business function, is not going to be kind of aloof and would need to be relooked at it. So that's kind of an overall overview in terms of the industry that is impacted and what impact would we see in transfer pricing. I would like to get my kind of panelists over here and get their view over here. So Jignesh, first what is your assessment of this economic as well as beyond economic impact of this pandemic, which will have on all the businesses? How are businesses currently reacting to this unprecedented situation?
Thanks, Jugal. Thanks, Maulik, for nice introductions, and Nexdigm for this opportunity. Let me start with a disclaimer saying that the views which I'm going to share with you guys today are my personal views and not necessarily represents that of Siemens. Now, coming back, Maulik, to your questions, you already elaborated exhaustively the impact on various industries this pandemic is having. But from just to restrict on a few aspects, and from specifically what we have seen is that this outbreak and the restriction on economic activity on account of lockdown is having a acute impact, especially on the cash flow. The focus of most businesses right now is on protecting employees, responding to the risk to their businesses, and managing the supply chain disruptions. As you will appreciate, the full impact is still unknown. Economies and markets have been hit hard by outbreak, and the businesses are making contingency plan to ensure their operations continue. The global outbreak is causing substantial shift in financial market and the macroeconomy, with immediate adverse implications on global supply chain and profitability. The customers are requesting for renegotiating the contract, enhanced credit period, and all et al. At the same time, there are new business opportunities for digitization of businesses. For example, especially for a company like us, which are into energy and power plant, so how power plant can be monitored remotely. So there are various new business opportunities also are emerging out of this outbreak. And especially now coming back to the topic of today's webinar, from a transfer pricing perspective, I believe most of the multinational enterprise would have already started to analyze the impact and the shifting of supply chain, production, target market, customer, which would have large impact on the transaction between the entities of such multinational enterprises. The multinational enterprises needs to carefully evaluate the change in transfer pricing policies and methodologies, considering the tax jurisdictions of the enterprise. Many companies will probably face restructuring solutions that are more recession driven. For example, closing down of a plant, restructuring charges due to laying of personnel, or write down of assets. Multinational enterprise should evaluate the potential transfer pricing impact of terminating or renegotiating intercompany agreements in the context of the facts, circumstances, functional profile, division of risk among the parties involved, and whether the behavior of the party and underlying economic substance of the transactions matches the terms of the intercompany agreements or not. As they say, substance over form. With that, I will hand it over back to you.
Thank you, Jignesh. Purnima, you want to share your thoughts over here in terms of how do you see this economic impact on businesses?
Yeah,
and how
hi. Yes, yeah, hi Molesh. I think thanks for having me here in this webinar. And I would definitely like to share a little different perspective altogether. Being a very positive person, how I look at it, that although we are all talking about, most of the global economies are going down, and the IMF have also kind of revised the kind of growth, GDP growth projections for most of the countries, including India. But I believe that this is also a situation that is not really going to last long. Once we actually have a vaccination in place, it's just a matter of maybe a couple of quarters in which probably the life would become normal. And in that case, the countries which will, or rather the companies which will take a very long-term view and take some drastic steps in the current situation, I think I'm not sure how will that going to really work for them in the long run. So I think people really need to look at it that yes, this is definitely a very difficult situation. The entire economy is kind of getting impacted everywhere. All countries are getting impacted, but there are also the industries which are actually expected to flourish a lot, and it is also creating a very big business opportunity for completely different process. So it's definitely a disruptive thing. I would say the traditional industry are definitely getting impacted. Technology is probably will be evolved in a very different manner. And because since I'm coming from the technology companies, I would say that actually there are lots and lots things are happening around that. Although we know maybe the auto industry, logistic, aviation, the tourism, the entertainment, hospitality, these are the kind of bigger things which are getting impacted. But in the long run, we actually will see that the healthcare, technology, telecom would actually, get into a very different space altogether. And it's basically, of course, the time to look into from the transfer pricing perspective that how the different business organizations kind of look at this particular opportunity, and how do they really grab. So I think it's not really that bad a situation to really change the very long-term strategies. Yes, we'll have to realign the short-term strategies, but I'm not very sure about the long-term. Let in the long term is not really that bad.
Interesting perspective, Nima. Like you mentioned, it's very kind of there is definitely some positive side to it. And like few months back, if you would ask the tax professional or an auditor whether he will be able to work from home continuously and kind of complete the books of accounts, auditing and everything, the answer was a kind of a big caps no. But yeah, we are listed companies getting results being declared on a day-to-day basis. The accounts are being audited. So pretty much without a significant disruption, at least certain functions are moving on. So and people are finding new ways to deal with that.
Yeah, since you're kind of talking about this, I would just add one more comment there without taking much time. Like now you see the resource deployment has actually become much more efficient. And then the moment, there is a correction happening all the time. And then all these type of situations help us to get out of the inefficiencies and kind of look at the situation in a very different manner. And it actually disrupts. So yes, there is a short-term implication on everything whenever there is such kind of big change happening. But I think in the long run, we will actually get into a very different level altogether once we are out of all this.
Interesting. So let's kind of get a little bit more deep dive into from a 30,000 feet level more into the at a ground level in terms of what kind of changes that are happening in the business models and how transfer pricing is impacted because of this, and how as kind of as a tax function, what can we do to kind of help the business in managing the current situation. The most important impact of transfer pricing, like I mentioned earlier, is on the supply chain distribution. The entire supply chain is kind of disrupted right now. The affected regions are where the heart of many global supply chains. The companies are rethinking in terms of their manufacturing models, in terms of their centralization of manufacturing functions. The cost of supplies is increased significantly from various regions. Certain businesses are forced to work through alternative sourcing strategies. Factories that want to operate are facing shortages of raw materials. They are not able to meet their contractual obligations. So a lot of this impact is there because of the supply chain disruption. And people are looking at kind of relooking at their manufacturing footprint, relooking at the distribution location and partners, how to procure their raw materials and other components. They're kind of re-evaluating whether it does make sense to have my own manufacturing facility or outsource to a contract manufacturer. So insourcing versus outsourcing is kind of getting discussed and getting re-validated right now. So a lot of aspects, a lot of work is currently going on the supply chain side, and this would kind of definitely lead to a change in or a change in the entire supply chain model of a large multinational company, which may have an impact again on tax and transfer pricing considerations. So one needs to kind of consider what these changes are there in a supply chain, how these changes are affecting the function, assets, and risk analysis that was done, whether there is a significant change to that, and how do you kind of do you look at this change as a business restructuring, or is it just a kind of a minor change, does not really affect the restructuring part of it? So a lot of these things would need to be kind of looked at, and a lot of these things needs to be put into perspective, and the tax and the transfer pricing teams would have to work together with businesses and the supply chain teams of the organization to work out the impact of what's currently going on around this disruption. Your perspective here will be important for, especially for manufacturing companies that are operating internationally. Supply chain management is one of the most crucial business functions, right? Businesses would kind of start rethinking on their manufacturing base, on their distribution policies, on their procurement policies. What is your thought in terms of what are the top 3 tax or transfer pricing considerations that one would see when you are relooking at the supply chain?
Thank you again. Yes, definitely due to lockdown and sealing of the international borders, coupled with ongoing trade war between US and China, multinational enterprise facing disruption in supply chain, shortage of material and labor, may consider shifting the existing manufacturing, assembling, research and development, supply chain functions, captive support functions from one jurisdiction to another. This could lead to shift from centralized to decentralized supply chain model, as you mentioned in your introductory or industry overview. Broadening of supplier base, maybe as you also mentioned about whether to insource or outsource. In coupled with that, renting or sharing of the infrastructure can also be looked at. This restructuring could be temporary or it could be permanent. So it depends upon each multinational enterprise objective and the acute shortage they are facing with. Uh, while moving the base may not be as simple, certain countries like South Korea and Japanese firms have increased interest in migration towards production conducive economics like India, Vietnam, and Thailand. Cambodia, Indonesia, and Bangladesh have also upped their games as suitable manufacturing hubs. So apart from the business consideration like proximity to customers, availability of raw material and labor, purely from a tax perspective, choice of jurisdictions becomes very important. In this regard, one may have to evaluate availability of tax incentive and ease of obtaining approvals required for obtaining those incentives. Profit repatriation alternatives, means available to achieve certainty with respect to tax and transfer pricing positions. Whenever one prepares a business plan case for any new setup, the certain tax cost helps in better predictability. As regards the TP considerations, considering what we just discussed, the changes in functional profile of entities involved and transfer pricing regulations of corresponding tax jurisdiction needs to be critically examined well in advance to avoid any adverse inferences at a later stage. The change or shift in value addition in supply chain and corresponding impact on profitability will necessitate the re-evaluation of functional profile and remuneration mechanism. So in all, a detailed study needs to be done before any decision is taken to move from a particular jurisdiction to a new jurisdiction, because as you know that at the end of the day, businesses will require a business case and a rate of return on investment. So having a proper rate of interest and a proper business case will make a multinational enterprise to think to change manufacturing base from a particular jurisdiction to another jurisdictions. Thanks, Malik.
Right. Thank you, Jignesh. Purnima, from IT and technology company perspective, do you see there may not be so much of a disruption on the supply chain side, but you mentioned the productivity and the efficiency is kind of seen to be improving. So how do you think this has impacted the IT technology company more so? And do you see any major issues coming out of it? I don't know, the security of data is relevant for companies, and is there an additional cost for people to work from home?
Yeah, hi, Molish. I think this is a very interesting situation when it comes to IT and technology organizations. I think we are experiencing a completely new normal, and it is breaking our own assumptions. Let me tell you, actually, when we actually looked around, and I speak to my other people in the same industry, most of us feel that actually the productivity of the employees has actually not gone really impacted. Most of the employees, when we actually speak to them, they actually share that now the stress levels have actually gone down for them, because they don't have to really travel through, to come to office through the traffic. So they are saving a lot of time. Technology is actually helping them to remain connected all the time. So I think their working hours, they are happy to put in more number of hours. So that is a very positive side of it. And it is a kind of virtual workplace for them. So I would say, from the IT industry perspective, we are not, frankly speaking, seeing any negatives, but I would say a little bit more positives around that. Now, the other part, when it comes to data security and the cyber security, that type of stuff, definitely now, organization to organization, I think in the IT industry, it has been a long effort ongoing to really make the employees aware of their responsibilities. And I think almost, all the companies are working very heavily on that. So there is a code of conduct policy, and there are internal rules, regulations, and many times whenever you actually log into a particular workplace, it is actually going through a controlled channel. So in a way, technology is also helping us to protect the data, and also it's like we are expecting the employees to get matured. And since we in India, the IT industry has been there now for 2 to 3 decades, I think that maturity is really building up. And we, of course, when we build a culture in the organization, we actually also trust is one of the biggest element that we actually would like to really, inculcate amongst the employees. So maybe in the pockets there might be something which is probably not happening in the right manner, but I think that's a very small piece of it, and I'm sure the companies would actually have their own ways to deal with that. So frankly speaking, if you really ask me, how has been the situation, impacting IT? I would say it's really definitely not a negative sign for us.
All right. Thank you so much, Purna, for that insight. Moving on, if you look at the other models which are kind of prevalent, we see a limited risk distribution model being kind of used significantly in the various parts of the globe. We basically in LRD, LRD is remunerated at a fixed margin while it is selling to a third-party customer. The purchase of finished goods from the principal manufacturer is kind of adjusted to ensure that the LRD at least gets a fixed margin, maybe anything 2%, 4%, 6%, depending on the industry and the benchmarking analysis. Now, in a scenario where we are kind of right now currently, where the principal manufacturer may be kind of incurring losses, it is kind of struggling to meet the sales demand. There is a decrease in third-party sales for the principal manufacturer. Even for the LRD, there will be a significant decrease in the sales because of the lockdown situation. This is kind of put the LRD model into a very a precarious scenario right now. The LRD would continue to incur certain costs during the lockdown period. Cost of selling general and administration kind of cost of employees. While the salespeople are not out on the field, they are still kind of being paid. There will be situations where kind of even if there are orders from third-party customers, because of the supply chain disruption, the LRD is able to not being able to procure that from the principal manufacturer and supply to his customers. So there could be certain kind of issues around that. So in such a kind of a scenario, both from an LRD perspective, one is to think how do you look at the cost of kind of the cost of operating in a lockdown scenario, in a scenario where there are kind of 2 or 3 months of virtually zero sales. From a principal manufacturer, the question would be: is it possible to pass on the losses that the principal is incurring to the limited risk distributor? Is it possible to kind of reduce the profitability of LRD? Is it possible to restructure or recharacterize the LRD by changing the transfer pricing policies? So a lot of these considerations would come when you are looking at an LRD kind of a scenario. We will discuss in the later part of the presentation in terms of how certain economic adjustments and certain comparability adjustments can be taken on. But if you are in LRD, one needs to think through all of these aspects and see what are the changes that are required in your business lines. Generally, we see LRDs being, especially where the margins is fixed based on interquartile range, there's a possibility to reduce the margin by going towards the lower end of the interquartile range, and therefore providing some relief to the principal manufacturer. So those kind of change options can be evaluated. Those kind of analysis has to be done in terms of what are the pros and cons. If I do that, what risks are there? Am I be able to justify that to the tax authorities as and when it being questioned? So those things one has to study and then kind of take a decision in terms of revising or looking at the transfer pricing policy for the LRD. And same is the case with a captive service provider. Basically, if there is a captive BPO, captive IT company, or maybe a contract manufacturer in India where it is kind of providing services, typically captive service providers, contract manufacturers are remunerated on a cost plus basis. The question is that if the parent company is making losses, is there can I just kind of reimburse the cost to the Indian entity without giving any plus? Can I kind of take away some cost from the total cost base, which are cost basically of the lockdown period or cost of unutilized capacity? Can I treat them as non-operating? Can I reduce the markup? If not, make it zero. Especially for captive entities, is it possible, since I need to conserve cash at the headquarter level, is it possible for me to kind of relook at the credit policy, and especially when the RBI has given permissions for kind of relaxation, is it possible to review the credit policies or not? Can I change the cost plus model to hourly rate model? So a lot of these questions and a lot of these considerations would be there for captive entities, and one needs to kind of look at how to deal with this kind of a scenario when we kind of start looking at making adjustments to the transfer pricing policies. So Purnima, yours being a captive thing, what's your estimate on the reaction of the tax authorities when you say, okay, let's reduce the arm's length markup, considering there's a reduction in the group profitability? Do you think the tax authorities would accept that?
Yeah, sure, Maulish. I think maybe I would like to kind of share my perspective from two different ways. One is that there are certain segments which are facing the challenges and which will face the challenge for some time to come, and then there are certain segments which probably are not impacted so much. So let's kind of first consider the segments which are really getting impacted, because you have already listed down a very I would say useful information and the inputs here. So naturally, the segments which are really getting impacted, they might be having their GICs, maybe logistics, or maybe aviation related, or the travel, all that type of stuff. And they actually have a large number of people sitting here supporting them so far when it was a business as usual. And with this pandemic situation coming in, suddenly now there is no work there left for the people to do here from India. And in that case, how do we really take care of it? And then, from the transfer pricing perspective, actually it goes back to the TP documentation. And if the companies have already opted for the advanced pricing agreement, what type of risk profile and FAR that they have kind of denoted there to arrive at the kind of a markup that is kind of agreed. Now, assume a situation that the capacity risk has already been identified as not a risk in India, then again it becomes a debatable issue, because then, for the intercompany contract, you said that the capacity risk is actually not with you, but it is actually with your group company or with your parent company. In that case, it actually becomes a legally tricky issue that, okay, how do you now, just because now a new situation has come in, you want to now reverse the whole thing. And there is, of course, a procedure involved to really get it reversed, but how will you handle that in the current financial year? Because you can't really do that, retrospectively. So that's definitely a challenge to be handled. But assume a situation that the capacity risk is actually kept here in India in the TP documentation or the functional analysis. In that case, definitely we probably have to look into our internal systems to capture the cost separately, and to see that, okay, to the extent that I'm kind of providing my services, how do I backtrack the cost incurred only to kind of deliver that type of work, and how I'm able to kind of take out the other cost in my P&L account. And then when, of course, I will have to share that with the tax authorities when the assessment would happen. Naturally, this particular topic will be a topic of lot of discussions and debate, and you have to really have a very good set of data available with you when you kind of bifurcate your cost. So that is very, very important part. So I think the FAR analysis that we have submitted, that would actually become I would say the key here. Yeah. And then coming to the another piece, wherein we say that the segments wherein probably there is not such a big impact. It could be like industries like healthcare or maybe telecom or financial sector, because financial sector, of course, will see the impact, but maybe you still have to process lots of transactions now, because now we actually see some of the people have started taking out the funds. So that means you still have to support that, from the India perspective. So maybe the home office is actually getting impacted to certain extent in terms of the percentage profit, and then, but you actually have a lot of work here. So it is possible that you are actually not getting rid of your capacity at all, or rather you may have to really add maybe more resources, or ask the existing people to do a little bit more overtime to finish the kind of work that is coming to your way. And in that case, from the India perspective, it's going to be tricky that how can you really go ahead and then ask for the reduction. Now your cost base in that case remains the same, but if you are not into the profit split situation, you are in the cost plus situation, how do you suddenly just go and then ask them now to reduce the markup? Of course, it's doable, and that has to be really think through by everybody. But if it is a really long-term situation, then it makes sense. If it is a short-term situation, then you have to actually rely on the benchmark study and then see if the API is already signed. I think all of us understand that just changing few of the things in the API for just 1 year or two, it's a cost-benefit analysis that one has to take. That's what I would say.
Right, sir. Thank you, Purnima. So I kind of understand that yes, cost plus entities need to have a hard look at their policies. I know there is a temptation to reduce the markup, but whatever reduction in the markup is kind of contemplated should be backed up by a proper benchmarking analysis, some kind of economic existence because of the current scenario, and then look at whether the markup reduction is warranted or not. Moving on the entity side, again,
first of all, we have to also find out whether there is a business impact really happening, because what is the trigger to change something fundamentally? For example, I was just kind of looking at my own data. See, because of the work from home situation, we are actually saving lots of operational cost, because infrastructure and the employee benefit is actually the second biggest cost that the IT organizations incur after the payroll. Facility cost has gone down drastically. Most of the benefits that we provide, say free employee transport, managing the different shifts, providing the escorts, and it is a sizable cost because of the sheer number of the employees that we actually have. And then considering all that, actually my cost of operations is actually going to go down. Although we might be supporting by paying some extra, maybe reimbursement to the employees to be ensured that they are all the time connected, and there may be Wi-Fi cost or internet cost is all we are paying, but that extra cost is, I would say, getting set off in a big way, to the savings that we are doing on the facility side of it. And also another very important part here to see, our exchange rates have kind of very big way got impacted because of the scenario. And then again, going back to the FAR, if suppose we say that the foreign currency risk is not kept in India but is passed on to the home office, in that case we are actually invoicing much lower dollars here, because now we see that the dollar, the rupee has actually appreciated almost, I would say, around 5%. So that's the straight away cost saving in addition to the operating cost that is going down. So in a way, your cost base has actually gone down. So you are helping the group in a way, to reduce the overall cost burden at their end also. So I would say these are all the different things. I know different segments, different companies face different situations, and it may not be the same. So in the IT sector, I would say specifically, depending on which area that you are supporting, it actually makes a very, very big difference, and you will actually have a very different experiences to deal with.
Absolutely. Moving on the entrepreneurial side, if there's an entity in India which is a licensed manufacturer, generally would tend to make third-party sales here in India and earn its own profits, and you used to repatriate say payment for management charges, payment for royalties, for the IP, for the technology, for the brand, for the group support that is coming over. They may also have borrowings, and therefore there could be a finance cost for these companies. These companies will also be kind of significantly impacted. There will be, obviously, there is a decline in third-party sales, and therefore the profitability of the Indian company would be under a challenge and would be kind of would be under stress, and would have to be justified to the tax authorities. At this point in time, the quantum of royalty payments would be questioned, the quantum of intra-group services charges could be questioned, and therefore there could be issues around justifying this payment. There could be certain relocation of some functions because of people being stranded in different locations, and new locations kind of being there for performing the functions. There could be scenarios where there could be a specific charge coming from the group on account of crisis management, because COVID crisis management, and because there's a significant level of top management spending time on the crisis management in each and every country, and therefore that charge also could be an additional charge. So even for a full-fledged manufacturer, the questions and the issues are going to be alive. One needs to start relooking at the quantum of royalties, and if there is a requirement to relook at the amount of royalty and intra-group services being paid, one has to look at the actual performance of intra-group services. If during the lockdown was there an actual intra-group service being performed, or there was a relaxation there also, and therefore there is a requirement to kind of look at that part. Jignesh, I want to get you over here. What is your perspective? The entrepreneurial entities are going to kind of suffer significant losses. How do you think one can justify these losses with the tax authorities?
It's a very tricky question, at the same time relevant and a practical one. And I'm sure if the discussion has not already happened, there will be intense discussion and deliberation between the headquarters and the regional entity management on this topic. It depends upon how the functions, assets, and risk have been documented in the agreement, and the prices and the remunerations of all these entities have been determined at the first place. Generally, if any situations, if you see there are losses, then a root cause analysis needs to be performed for the operating losses, and see what has to be passed on, and who is the default for these losses as such. As you know, that what we are talking about right now is a very exceptional situations, and there may be a gray area where whether Indian entity is also not responsible for such expenses, whereas the headquarter is also not responsible for that kind of expenses which Indian entity is incurring, or the overseas entity is incurring. So definitely what need to be done is that what have been documented in the past TP studies, what has been FAR profile, what has been mentioned in the master file needs to be respected. And I would say this is a once in a lifetime opportunity to demonstrate and stand by the functional characterizations of the entities, be it limited risk distributor or captive service provider. Any change in compensation needs to be properly thought through, and keeping in mind future implications. As you know, that in India we have very high level of TP disputes. So I mean, one needs to be very careful while determining any cost to be taken for management cross charges, or there could be for the royalties or management charges and all that. There could be the Indian entity could ask for the moratorium on those charges, and try to justify or to mitigate the transfer pricing risk from that perspective.
Thank you, Jignesh. Moving on, let's look at one important aspect of the transfer pricing which will be really impacted is on the financial transactions. The entire financials of the financial arrangement of the company would be relooked at. The external financial arrangements may be kind of brought into picture. Liquidity management would be one of the most important priority for the management. There will be some recharacterization of short-term loans into long-term because of the liquidity part of it. The companies would look to establish the cash pooling solutions for kind of fluctuating. There could be interest rate deferrals, moratoriums being announced. Like I mentioned, the RBI has already announced moratoriums for Indian public at large. So similar moratoriums could be present in intra-group funding arrangement. One has to revisit the interest rates based on the rating change, if at all there's a significant credit rating change that would happen because of the situation. There could be an additional support from the parent on account of by providing more guarantees. It could be equity infusion or converting the existing debt into equity. So the entire funding pattern of an organization and the transfer pricing policy associated with the funding pattern would have to be looked at it. This is more important from Indian companies who have made investments abroad, where kind of typically a LIBOR plus 200 or 400 basis points kind of a interest was charged. Whether there is a requirement to relook at the interest rates being charged if the overseas subsidiary is kind of not doing so great. Is it possible to kind of waive interest for certain period, or at least defer the interest? So all these considerations will come into picture, and the tax authorities will also examine this extremely closely in terms of what kind of changes that are taking place in an organization and how the organization has reacted to the changes in with respect to repricing of the financial transactions. Jignesh, your view here, liquidity crisis would be a major challenge for every businesses. So do you think bailing out the subsidiaries by kind of either converting debt into equity or providing moratoriums, etc., they should be kind of a shareholder function, should be kind of not be subject to a transfer pricing adjustment by the tax authorities?
Acha. Before I offer my personal view on this matter, it is very important to know that recently, as recent as on May 29th, in the United Spirit Limited case, where interest-free loan was given to subsidiary, Bangalore ITET observed that Chapter 10 is titled as a special provision relating to avoidance of tax, and held that the expression international transactions has been defined to include capital financing, loan transactions, etc. And hence, there should not be any dispute that the impurged interest-free loan given by the taxpayer to its association shall fall within the definition of international transaction. And accordingly, if the loan is given free of interest, then same should be construed as having been given at a zero interest. Further, it needs to be tested under the arm's length principle under section 92(1), even if no interest income is contemplated between the parties. So even the real income theory has been negated by the tribunal. So in having such judicial precedents currently available on at the ITAT level, it is difficult to take a position that is a shareholder functions, and there may be require to take this as a related party transaction needs to be benchmarked properly as such. And any case, as you already mentioned, that there are a lot of government supports and which has been given and all that. So to be honest, so one needs to do that how the third party would reacted in such situation and what the third party would have given such loans and all that. Especially when you talked about that rating of a subsidiary has gone down, by which the subsidiary itself on its own is not able to obtain any financial assistance from local banks. In my personal view, it could be regarded as a shareholder functions because you are bailing out your subsidiary, but you never know if we have certain judgments which says that irrespective of of your situation of the subsidiary, once it is transactions are classified as international transactions and you need to benchmark, I don't know how much with precision you can make economic adjustments for such situations which you just elaborated. But it's a very tricky situation. And even if you look at OECD guidelines, when it clearly says that independent borrower also considers the potential impact of change in economic conditions, the risk of not being able to make timely payments of interest and principal on the loan, and there has to be a renegotiations between the borrower and the lender. So in that situations, I think so it could be said, especially if the loan given from an Indian parent company to a subsidiary outside, it could though may not be at the highest rate what you talked about, the interest should be charged or guarantee fees needs to be charged, but there may be some charge may be applicable thereon, so to avoid TP risk.
Absolutely. Very interesting perspective you mentioned about the OECD guidelines. The revised OECD guidelines on financial transactions that were released earlier this year kind of requires to kind of actually delineate the transactions, and actually requires us to kind of even benchmark the amount of the quantum of loan versus the quantum of equity. So I don't know whether the applicability of that in COVID times, how one has to look at it. But yeah, financial transactions will come under a lot of stress and a lot of scrutiny from the tax authorities in this period.
Yes. And just to supplement, from an inbound perspective, one needs to be mindful of thin capitalization rule under section 94B, deemed dividend issue, and apart from the regulatory issues of NBFCs and others, if you provide intra-group loans. Yeah.
Absolutely. Very quickly moving on, I have kind of very close to our closing time, so I will not take more time. I'll just keep through some of the slides. But one important aspect that I wanted to just bring it out over here is that a lot of the changes that companies are contemplating to do because of COVID-19, one has to be extremely careful whether it results in business restructuring or not, and kind of what the consequences of business restructuring. So, for example, changing a LRD into a full-fledged distributor would definitely be regarded as business restructuring, and there could be a requirement of a one-time compensation for changing such a model. So one has to be extremely mindful of the fact of business restructuring and see where it is all triggered. We need to kind of keep that in mind before taking any decisions. Some of the things that one has to be careful is on the benchmarking part of it. There are these extraordinary adjustments that would happen because of COVID-19. Right now, the data for comparable companies is not available. To certain extent, quarterly data would be available in the coming months, and one can look at the quarterly data to find out the impact of the COVID-19. The MCA has released a guideline saying that companies should disclose the impact of COVID-19 on their businesses and operations and on financials. So if the financials reflect the changes account of COVID-19, the impact of COVID-19 on financials, one will be able to look at that and kind of make those adjustments. So adjustments on account of idle capacity, on account of extraordinary expenses, on account of unprecedented exchange rate fluctuations would have to be kind of looked at, and such adjustments would have to be made to the comparable companies or to one own set of financials. Although there is a legal challenge in terms of whether adjustment is allowed to the tested party itself or not, is a legal challenge. But given the scenario, if adjustment is not possible in case of comparable companies, at least one should carry out in their own case and make it kind of and demonstrate to the tax authorities that the profitability is affected because of the current scenario and not because of the intercompany pricing. Similarly, certain things like multiple year versus single year approach would also now come into picture. Till now, the taxpayers were looking at kind of going beyond 1 year and say using of 3-year or 5-year data to benchmark the transactions. Perhaps for the year 2021, one can look at only single year data because the past year's data and single year data would not be kind of matching. One has to relook at the target subsets of comparable companies. At times we used to reject loss-making companies. We have to see whether rejection of loss-making companies is really warranted. And the last thing is that obviously you have to look at the arm's length range. The tendency is to kind of go by the median or slightly above the median, but there is an option available because the arm's length range is from 35th to 65th percentile. There's an option available for the taxpayer to look at the lower end of the range also in order to kind of benchmark their transactions. Same way, certain economic adjustments needs to be carried on in terms of working capital, like I mentioned, capital utilization. There are certain fixed costs that the organization would have incurred, and therefore can we kind of reduce those fixed costs out of, take the fixed costs out of the picture. Please bear in mind whatever adjustments that you do with vis-a-vis the tested parties, similar adjustments would have to be done for comparable companies, and therefore availability of the data for comparable companies is going to be a major challenge. One more point that's kind of is critical to examine is the APA. If there is already a signed APA, what do you do about it? Does the critical exemption cover scenarios such as pandemic, etc.? Are any of the critical assumptions getting invoked? Do you go back to the tax authority for renegotiating the signed APA? If countries such as New Zealand is already kind of granted an exemption from achieving an outcome which is different from the agreed APA, so do you think that government in India would come out with some kind of a guidance that APA needs to be reviewed, or can the APA be paused for 1 year and can be kind of not applicable for financial year 2021? In terms of ongoing negotiations, these scenarios need to be built into the critical assumptions so that in future, even if there's such a scenario is there, the APA holds good. So Purnima, I want to get you over here. What do you think should be the taxpayer strategy in terms of people who already entered into APA? Should they continue to apply the APA as it is? Should they look at renegotiating the same?
Yeah, I think Maulish, this is a little tricky question, and I think I'm sure every organization will have to evaluate what they should really do in this particular situation, because as you rightly pointed out, the critical assumption actually becomes very important here, key to decide. And then we also have to see, like specifically from the IT and technology companies' perspective, is there a business impact? Because only then it really makes sense, to go ahead. And how long really you see that the business impact on you will continue. If it is a really short term, then probably one has to really evaluate that whether there is a cost benefit analysis, makes sense to really go and talk to the tax authorities to revise the APA, which is already signed, because we all understand the pain and the time that it takes to, get something closed with them, with the tax authorities. And if it is your ongoing APA, definitely this is actually a learning lesson for us to that how do we really build the critical assumptions that if at all in future a similar situation happens, then how should we safeguard ourselves at that point of time, and already kind of take a particular stand in that. And the most important point I would say that the benchmark data, like when we say that we have to go to the APA authorities, do we have a good benchmark of data? Because that seems to be a challenge from all perspectives. We may do some theoretical assumptions, we may do some kind of number crunching to kind of justify whatever we want to say, but naturally different organizations will actually have a different strategies to optimize the cost. And in the pockets, specifically to the IT GICs, I would say it is actually opportunity to kind of get into the next level with their home countries, wherein they can actually support the group companies with the kind of higher type of work that they are doing from here. And at the same time, the cost arbitrage that we really see here, that because of the financial challenges which we see in US and Europe, which is likely to be there for some time. Naturally, the more work is likely to come to India, because that's a very easy way for them to actually reduce their cost base there. So considering the holistic view, one has to take a view from the India perspective. If it is a unilateral APA that is already done, what should you really do? If it is a bilateral, then how does it really make sense? If it is a profit split method, yes, it will automatically correct itself, because if the group profitability has gone down, the country, the companies here in India also would actually get a smaller piece of that. And also one has to think that if, in the current APA scenario, if there is a super profit situation that happens in, say, your counterpart, is your APA is supporting to get that extra piece of it? Because we should not be just one-sided, that there is an impact, we should actually take a piece of it. And if it is a super profit, then we should not think of it. So if your balance, if your critical assumptions, the APA are balanced enough to really convince that, because I think we also need to understand that our country also needs, a revenue to be generated through the tax. So I would not, just because of a finance professional which we are responsible, we should not just push the organization on one side. We should actually take a holistic view, which is fair view from the company's perspective and also from the country's perspective.
Absolutely. Thank you so much, Purnima. Just concluding on the webinar, a lot of what we discussed in terms of there are impacts on each and every area on the transfer pricing side, and one has to look at it. It has to start at a group level, the first assessment of the business impact areas and the magnitude of such impact. Like Purnima mentioned, really, is there an impact on the business or not? One is to look at that. We have to look at the solutions to address the impact. There needs to be work done at a country specific level, where there's a requirement of either realignment the cost plus margin for a captive, or revisiting the profit margin for a contract manufacturer or LRD. There is requirement for an intercompany amendment in the intercompany agreement. In terms of documentation, one needs to kind of look at changes in FAR profile, look at the comparability analysis in more stricter sense and more stringent, and look at comparability in more deeper aspects in terms of making the adjustments on account of COVID-19, and kind of obviously one has to constantly monitor this over the next 1 to 2 years, till the time the impact of COVID-19 is there on the entire thing. So there's a lot of work that is required to be done to ensure that your transfer pricing policies are in line with the current scenario, and are not kind of facing any issues on account of the adjustments by tax authorities. Jignesh, Purnima, your final thoughts on what do you think, what specific steps companies should take at a global level and at a country level to kind of look at in the current scenario? Jignesh, maybe you first.
Yeah, thank you, Maulik. One major thing which everybody can do is speeding up the digital transformation to create a digital enterprise by automating e-processes and focusing on integrated distribution channels, preparing a workforce with the new ways of working by developing different skill sets, revisiting cost structures by streamlining overhead costs, centralizing activities, and exploring economic of scales, sharpening productivity by achieving flexibility in supply chain and focusing on most profitable markets. From a tax and transfer pricing perspective, when you are looking at the change in the supply chain from one jurisdiction to another jurisdiction, tax incentive which various jurisdictions are offering while supply chain alignment is done, robust documentation to support the reasonableness of the profit and loss impact among the various entities of the group during the post pandemic period, and continuously look for the need for change in the transfer pricing policies. And as Purina already mentioned in the previous section of the APA, we are facing cash flow problem, the mindset of the tax authorities that scrutinize the tax matters will be affected by the economic cash flow. Therefore, any change in the intergroup policy will be subject to close monitoring for the base erosion and profit shifting. Please ensure that the way an organization reacts to the crisis is aligned with the conclusions of DMP functions in your master file. That's it from my side, Maulik.
Thank you, Jignesh. Purnima, your thoughts, closing thoughts on what should companies do in the current scenario?
Yeah, sure. I think, this is what I think, that we should not really get panic about the situation. We know the situation is difficult and it is unprecedented so far. But we should not really rush on taking some kind of long-term decisions based on a short-term situation, because it is quite possible that maybe the vaccine would come and the business has a great ability to adjust itself. And I'm a kind of great believer of that. And every difficult situation actually gives rise to lots of opportunities, which probably so far we have not thought of. So I think in this situation, we really need to be kind of creative to see, okay, what really can work and what really makes sense. How can I really create a value proposition in the whole situation? From an India perspective specifically, this is opportunity to actually climb up in the value chain, because I think the technology sector has kind of achieved a lot of maturity, and it's a time to really make a presence felt in the international market. And that way you can actually bring in a lot of value on the table for the group company to be successful. So I would say, okay, coming up with a lot of good ideas to how can we actually contribute to the business in a proper manner, I would say in a very different and creative manner, because this is a disruptive situation and this is an opportunity which probably we will not get again in a shorter period of time. So I would say that yes, when we deal with the tax authorities, we need to be fair. The finance professional, we need to be fair with our countries, we need to be fair with our group companies, we need to really be vigilant about what's really happening around and how are we really balancing the whole situation. That is what I would say, Maulik.
Thank you so much, Purnima. Thank you once again for being a part of this panel and kind of sharing your most valuable insights on this thing. I'm sure your perspective has kind of really enriched the experience of our audiences and participants on this webinar. There are a few questions that have come to us on this thing, but we have really overshot the time. So I promise to get back to them individually on the questions that they raised and answer those questions. Since we have kind of already overshot the time, give it to Jugal for your closing remarks and closing the webinar.
Thank you, Maulik. Thank you, Purnima, and thank you, Jignesh. This brings us to the end of today's session. Once again, we thank all of our participants and panel members for your time. We hope that you have drawn a great amount of insights from this particular session. For all of those who still have questions, and apologies if we've not been able to answer them, please send them to us at thinknext@nextdigm.com. We shall definitely get back to you on an email with a response. Thank you once again, everyone, for joining in. From all of us out here, stay safe and stay healthy. Goodbye.
Thank you so much. Take care.
Thank you. Thank you.
Thanks, Jignesh. Thanks, Purnima.
Thank you. Bye.
Thank you. Bye.